Yo, it's your boy Phyllis, and welcome back to another interesting episode on 12 of FX. And in this video, I will be analyzing Fidelity Bank PLC, which is a public company that is traded on Nigerian stock exchange market. So, without further ado, let's jump right into the chart. Guys, whenever I'm analyzing any chart, the first thing I always do is try to get the direction of that asset. And one of the best ways of doing that is by going to the higher time frame. So, anything from the daily time frame down to the monthly time frame, I will consider higher time frame. The reasons for doing that is because going up to the high time frame gives me the overall picture of the market, and secondly, this is the time frame institutional traders such as commercial banks, large financial investors, and all these guys that trade huge amounts of money. Only three phases you can see the market. Either the market is making higher highs, higher lows, which is an uptrend, or the market is making lower lows, lower highs, which is a downtrend, or the market is moving within a range. In this case, the market has been making higher highs and higher lows because this was a high that broke this structure, and you have another high that broke this high, so it's higher highs, and you have a low down here, and you have a high, a low, this you have a low, and you have a higher low. So the market has making higher highs and higher lows, so it's safe to say we're in an uptrend. And with the aid of a trend channel, I could get the fractals of the market. In case you haven't watched my videos on trend channel, I would recommend you watch it on my previous episode, and I'll use it to get the fractals of the market. Because whenever you hear the word uptrend, always picture a five-wave pattern, be it an uptrend or a downtrend. It does so in a five-wave pattern using the principles of Elliott's wave. So in this case, this was the first wave, a retracement, and what comes after the retracement will be the third wave, which is an impulsive bullish wave because it is going in direction of the uptrend. So with the drawing tool, I could get the fractals. This is the first wave, the retracement, which gave the second wave, the third wave, which we end at the upper end of the trend channel, which we act as a dynamic area of resistance, a retracement, which gives the fourth wave, and the fifth wave. So currently, right now, we are on the third wave. And from the third wave is an impulsive bullish wave because it goes in direction of the trend. So meaning it's a trending market, and what to expect a five-wave pattern by observing the fractals of the market. So right now, by zooming into the third wave, I could get the fractals of the market by using a trend channel as well. By using a trend channel also, this is it. So this was the first wave, the second wave, and this upper end gave the third fractals. And what you get next will be a retracement and a continuation. So to get a drawing tool, this was the first wave, a retracement, which gave the second wave, the third wave, the fourth wave, and the fifth wave. Change the color to black color. So guys, what I just said right now is like this is just me explaining the market structure of these assets. But to gain an in-depth understanding of these assets, one needs to understand the psychology behind every single move in the market, and which is what I'm going to dissect in this video. So starting from this last bearish move down here, this move was as a result of institutional traders that shot the market at this region that resulted into this large bearish move. So what happens is that from them taking this sell trade, institutional traders have their stop loss placed above this region, which will constitute a pool of money we call liquidity. And additionally, you also have retail traders that see this area as an area of resistance, and they hope to take a buy trade on the break of this structure. So what happens is that they have a buy stop with their stop loss placed below here. So what happens that the contribution of the stop loss of the retail traders and the institutional traders constitute a pool of money which we call liquidity. So you have money resting above this region. And also, if you go down this bearish move, at some point you have them selling the market. You can see this area was a small high, and they sold down a small high, and they sold. So meaning you have internal liquidity, you have liquidity resting within this bearish move from sellers shorting the market. So what happens is that the market takes out internal liquidity and heads towards external liquidity and heads towards an external liquidity area. So on top of this area, you have this an external liquidity resting on top of this area, and within its move, you have internal liquidity. And look at what happened next. This first wave came, went upward, took out all this internal liquidity. So all the stop loss resting above, it took them out, and it head towards this external liquidity area. And after clearing the liquidity above this area, it mitigated. And when the word mitigation means like reducing the pain of something. That pain comes from before institutional traders took this buy trade, they sold the market before buying. So what happens is that you have an open sell position and a positive buy. You have an open sell position running concurrently with this buy position. So basically, you have two things happening from this upward move. You have an you have a positive buy position as in profit from this move, and you also have an open sell position that is running at a loss. So when the institutional traders have gone to their target area, which is this area of liquidity, they will mitigate their position towards closing that open sell position from there. I ask yourself, why does institutional traders, why do they sell before buying? Institutional traders, they sell before buying at area of resistance or area of support. So what you have is was an area of support where they sold the market before buying. A lot of people probably call this an order block or so, which is the last um, candlestick downward before an upward move. If you go scale down to a higher time frame, this probably give you a one bearish candlestick downwards, and you have an upward bullish candlestick. They sell before buying because it gives them a very good entry position into the market. Because these guys trade a lot of money, they trade huge amount of money, so they want to enter the market without getting disturbed by retail traders. Secondly, it's a way of generating liquidity. So you can see that from them um, selling before buying, you have internal liquidity resting in this region. So it gives them money to push their decision towards the target area. So they can take out all the stop loss resting from this last bearish move before buying. So it helps them taking out the stop loss, will help them pushing their trade towards the target location. So after mitigation, which is this second wave, what should come next will be a bullish move, which gave us the third wave. And this third wave is an impulsive bullish wave. So what to expect? A 5-wave pattern out of this third wave. Already, we could see this was the first wave that took out the internal liquidity resting at this region. So if I should zoom in words, the first move took out the internal liquidity resting on top of this area and mitigated. So mitigated by closing its open sell position as running at a loss because they sold before buying. So you can see it's mitigated by closing its open sell position. And what comes next will be a third wave. And at this area, this was where senior traders jumped into the market and they bought heavily. They went long. That resulted in this large bullish move. Why I call so at this area, this is an area of demand. Why I call it an area of demand? Because at this area, this was where institutional traders manipulated the market into them buying. So this was an area of demand because at this area you had an aggressive bullish buy that came from this area that led towards the break of this structure and this structure. So this is an area of demand. And it's not true that before they place a buy trade, they always sell before buying. So from them going buying aggressively at this area, they still have an open sell position that was running at a loss. After these guys have taken out all the internal liquidity resting at this region, they will head for this external liquidity. So they head for this external liquidity, or you can call it trend line liquidity. It's invisible. You have to look in properly to see it, which was what you saw. It came above this third fractal, head towards this area of liquidity and take the money resting above this area, because this trend line will induce a lot of retail traders to take a sell trade or to take a buy trade. So you have three things happening. You have retail traders seeing this area as an area of resistance because this is an upper end of a trend channel, and they'll take a sell trade with their stop loss place above there. You have retail traders that see this as an area of resistance, and on the break of this structure, they'll take a buy trade, so they'll place their stop loss below here. So the inducement, this trend line will induce a lot of traders to jump into the market, and that will result towards the creation of liquidity around this region. And that's where um, that's what institutional traders like. They take out internal liquidity and they head towards external liquidity areas. So you can see they've taken out all the money and they head towards this area of external liquidity. And when they come down here, they will manipulate the traders and take the money out and head downwards towards this area of demand, because they still have an open sell position that has to be closed. If not, they will be at a loss. So even though they were even though they were in profit from taking this massive buy trade, they still have an open sell position that's run at a loss that they have to close before going long. So what should come next will be a retracement, which is an ABC pattern that will gain a support around this area of demand, which will be at 2.88 or around this region, this area. And when the market gets to as low as this area, that's when you should take a buy trade. And your profit target should be at the upper end of this trend channel, which is at, let's say, around 9.53, around this region, so which is the upper end of the trend channel. So what you can do right now is just to wait for the market to come downwards, retrace towards the area of demand, then take a buy trade, and it will take out the money here and head towards the upper end of the trend channel. And that's it for today, guys. If you like what you watch, don't forget to like, comment, and subscribe. And see you guys on the next episode. Thank you.